Hey everyone, and welcome to our DAT IQ weekly market update. This is our update for December 1st, believe it or not, 2020. I'm Ken Adamo, Chief of Analytics at DAT, and we have a full house today. I'm joined by Ned Damon, who's our Principal Data Scientist, Dean Croke, Principal Industry Analyst, and our special guest once a month, Dr. Chris Caplice, who's Chief Scientist at DAT and head of the CTL up at MIT, just to get all my acronyms in. He's also a PhD. So
that's right.
Welcome, guys.
Glad to be here.
And you're at the beach, right, Chris?
I am. I'm on the Outer Banks of North Carolina, right by Kitty Hawk.
We had a snow day today, so I was kind of wishing we could swap places. So to jump right in, for those less familiar, we're here every Tuesday, except next week when we're here Wednesday. But typically, we're here on Tuesdays at 10 a.m. Eastern, 7 a.m. Pacific, to go through trends in the freight market, run through some of our forecasts and interesting things, and most importantly, to answer your questions. If you have any questions for us, please feel free to drop it in the chat or the comment section below, and we will get to them towards the end of the show. Before I forget, because I always forget, I want to make sure to plug Chris's Freight Find podcast. That comes out every other week, again, with just the luminaries of industry on this supply chain and logistics. So with that, I'm going to jump into our key points of the week. For those who may have recently forgotten, it was Thanksgiving last week, so I want to make sure to caveat that. And a lot of the charts we're going to look at, they might look a little funky, but capacity tightened rapidly as drivers and dispatchers. It was just, I'm sure, a mess last week. Load post volumes dropped, but again, that reduced capacity put pressure on rates. Pretty much in line with seasonality is, I guess, the overarching point. There's some timing that we'll talk about. I'm sure Dean will cover as we look at year-over-year comps. Thanksgiving happens at a different time every year. And then last week's ATA truckload tonnage reported a 6% month-over-month decrease in October, falling 8.7% year-over-year. I think it's important to note, correct me if I'm wrong, Dean, that's across all modes, right? That's just total tonnage. Or is it not across all modes?
Well, it's truckload tonnage, so it's truckload predominantly.
Does it count intermodal?
I'm not sure what the mix is, Ken.
Okay.
From the truckload carriers.
I guess we'll have our own question to answer at the end. Maybe one of us can look it up and answer that. So with that, I'll turn it over to Dean for market dynamics and rate trends.
Yep. Thanks, Ken. Yeah, short work week kind of played with some of our numbers and week-over-week comps this week, but year-over-year comps, everything's pretty much on track with the 3-day work week, lots of drops in volumes across all the equipment types. So last week, load posts in dry van were down about 40%. About 30% fewer drivers posted their trucks for loads, so that tightened up capacity as drivers loaded for home the week prior and took time off. Load to truck ratio dropped to 3.74 as a result. In the refrigerated sector, much the same, but capacity tightened rapidly. Load post volumes were down about a half, but fewer trucks in reefer took time off, so that only dropped by about 19%, had the combined effect of dropping the load to truck ratio down to 6.25. But as you can see from the chart, pretty much in line with the drops we see around Thanksgiving each year. So nothing untoward there with the change in the angle of the trajectory of the chart there. So flatbed, again, much the same. Volume dropped about 42%. Capacity tightened, 31% trucks posted for loads. So load to truck ratio, though, is very much in line with seasonality. Moving over to our market condition index, outbound volume dropped in all of our 10 freight markets on a short work week, so no surprise there. The average for all 10 markets was down 24% week over week on a 3-day shipping week. But notably, the volume decreases in Los Angeles, Ontario was about double that average of all the other markets. And a lot of this has got to do with the port congestion, excessive container dwell times. I mean, there's chassis equipment shortages, warehouses are at peak capacity. So there's lots of ebbs and flows in the volumes that are coming out of the port. Container volumes were up 34% last week, week over week. Looking at the Port of Los Angeles signal data, there's another big drop in container volume next week. But then there's a surge in the week before Christmas based on data coming off the vessels that are on the water right now and those that are about to dock. So again, I think there'll be a dip in volume next week, but an increase the week after. Why is that important? Capacity is still really tight. So for carriers and brokers, and shippers. Last week, rates moved up again about 6 cents a mile for dry van to $3.21 out of Los Angeles. And they moved up 5 cents a mile out of Ontario to $3.30 a mile. So even though volumes are down, capacity is still really tight and has been tightening for the last 4 or 5 weeks. In the refrigerated sector, same story, large volume drops. The notable exception this week was some volume started to come online in Lakeland, Florida. First harvest of strawberries was reported in Plant City, which is significant. There's a lot of volumes of strawberries and blueberries start moving between now and the end of January. It marks the start of the produce season in the south. Volumes were up 6% last week, but volumes are up for the 4th week in a row. So that starts to provide some balance for carriers that are game enough to run deep into the southern part of Florida. Capacity was very tight. I think it caught a lot of brokers and shippers off last week. Capacity, there wasn't obviously a lot of trucks. Rates out of Lakeland jumped to 18 cents a mile for refrigerated capacity, only up to $1.61 though. But rates were as high as $3.85 a mile for loads into Tennessee, Kentucky, and Indiana. In the flatbed sector, volumes continue to cool, probably the most of the 3 equipment types. Volumes in the top 10 markets dropped by about 40% week over week on average. Only 4 of the 135 markets we tracked weekly reported increases, and they were only small markets. So big drops in volume across the flatbed sector. Having a quick look at our year-over-year comps in spot rates, much tighter capacity during the holiday week. Ken mentioned it put upward pressure on rates. Rates moved up about 4 cents a mile to $2.31, excluding a fuel surcharge for dry van. In looking at year-over-year comps, rates are up about 73 cents a mile year-over-year, and they're up almost $1 a mile since May the 1st when they bottomed out at $1.32. In refrigerated, lots of last-minute pre-Thanksgiving loads and tighter capacity as drivers took time off put a little bit more upward pressure on rates, up 1 cent per mile to $2.57. There were fewer carriers took time off last week, though, so I think a lot of them are taking advantage of the record-level spot rates that we're seeing, which are up about 65 cents a mile compared to the same week last year. And lastly, in flatbed, after dipping 2 cents a mile the prior week, flatbed rates last week moved back up again, but mostly due to capacity tightening as drivers took time off. Rates ended at $2.20 a mile. They've been about that level for the last 8 weeks, though, so not much upward movement and definitely some plateauing there. So that's it for this week's market update. And if you'd want to find out more about what's happening in freight, go to DAT/market update and download the weekly report where we summarize a lot of these charts in much more detail. And that's it for the market update. Over to you, Ned, for the rate forecast.
This week's rate forecast is a little bit, it's more boring than prior week's rate forecast, which is good, but part of the reason for the boring is that I actually had to make some adjustments on the back end to our short-term model after the behavior that was seen last week. So
and that's another reason, Ned, right, why we don't. That's not our production model. It's kind of like been a trend of each week we've been sort of giving a reason why we don't use short-term modeling for our production. Sounds like we've got another one here, right?
Yep. So I made some tweaks to the short-term model, so now it's better able to actually mimic what's been going on recently. I know Cynthia did a really good job of explaining it, but essentially the short-term model has to replay the last couple of weeks of history in order to kind of fly forwards. And so given that the last couple of weeks have had some big trend changes, it's been interesting to try and recalibrate everything. Anyway, that's all kind of way under the hood, too much information stuff. But this week, now that things have been tweaked, we have very good agreement in van between their various models. To go through the chart, we have in blue the market rates that have been observed by DAT, and then off to the right, we have what we call our spaghetti. That's a set of different models. We have the RateCast, which is our flagship model, in green. We have the short-term model, which can be a little bit persnickety sometimes, in red, but it's kind of designed to pick up on short-term trends a little bit more closely and not follow longer-term seasonal patterns as strongly, as you'll see later. And then we have the blended forecasts in gold and gray. The two blended forecasts are mixtures of the two prior models in different ways and in different amounts. So you can see again in this van chart, there's a lot of agreement through till the end of the year. And then RateCast is expecting there to be a little bit of a bump near the end of December, it looks like, from where I'm sitting. Whereas short term, because it doesn't have that same level of seasonality that it's aware of, doesn't expect that. But the fact that there's broad model agreement, I think, is hopefully means that the things are going to be relatively smooth for the next couple of weeks. Moving forward to the reefer rates. Here in the reefer rates, you can really see where the lack of seasonality makes the short-term model sometimes a little bit silly. So here where RateCast is expecting a kind of standard reefer dip in through the middle of December before picking back up to follow on trend, whereas the short-term model, again, does not kind of expect that. RateCast model is our flagship model, and there's a lot of reasons for that. And again, in blue are the market rates that have been observed by DAT. In green is the RateCast model. In red is the short-term model. And in gold and gray are the two blended forecasts. Finally, we're going to be moving to flatbed. In flatbed, here we have a broad model agreement through maybe mid-December, mid to late December. And then when we get to the tail end, you can see that RateCast is expecting a little bit of a bump into the tail end, start of the year, whereas the short term is not. Once more, blue is the market rates observed by DAT, green is RateCast, red is the short-term model, which just takes into account short-term trends and not very much else. And then in gold and gray are the two blended forecasts. I think that goes through a set of forecasts, and we're on to our question of the week. Should I field this? Who should field this?
I think you should ask it, and maybe we can kind of go around the room and bat it around a bit.
Sounds lovely. So the question that we have gotten for this week from our IQ mailbox is, can we expect normal seasonal patterns through the end of the year?
I could take a crack at it first.
Yeah.
I mean, the year's pretty much baked, in my opinion. That's been my sort of talking point. I mean, I don't know that anything's going to happen. I shouldn't say that. It's 2020. I mean, we could have a giant chasm open up between the East and West Coast and swallow all of the Midwest. Within the realm of reason, I don't think there's anything that's going to happen that's going to alter the trajectory that we're on through the end of the year. I think the big question is what happens post slowdown, right? Post January and February slowdown. But I'll cede my time to the rest of the folks on the call.
Yeah, Ken, I think you're right. A lot of the volumes that we normally see late or certainly early in December, late season, I think a lot of those have already moved because we've been seeing shippers get ready for the online, retail season months in advance. We've been seeing Black Friday sales for 4 or 5 weeks now. But I think the big difference this year, and it was a great article by Jen Smith in the Wall Street Journal last week about returns and return season. We covered a little bit of it this week in my weekly update, but the big change will be return season. Not only higher volume, where some of the volumes from shippers are double what they normally be, but it's the size of shipments that'll be so much bigger this year. So because we've been buying bigger items online, I think the difference this season will be the size and volume of returns given the dramatic increase in e-commerce.
Yeah, I mean, the big hallmark for this year, as you were saying, Ken, is just there's so much uncertainty, so much going on. But if we look now compared to where we were, say, in October, a lot of the big sources of uncertainty are gone. The election is generally over. It's been decided, so that big uncertainty has been removed. The vaccine looks like it's been developed, and now it's just a matter of distribution. So the two big pillars of uncertainty have been removed, but I don't think anyone feels more certain about what's going on. We're still concerned with the lockdowns and how that's going to have an effect. The only silver lining there is we've lived through it before, so we kind of know how consumers are going to behave. We're still repeating our same pattern as of March. All the toilet papers disappeared, right? So it seems like we're going the same patterns. It's like Groundhog Day. But overall, I think we will return to seasonality. I think the crazy uncertainty is going to start mitigating. I think that's going to start, that wave is cresting. And I think Q1 will start return to more normal-ish conditions is my thoughts.
Yeah. Good point.
I think the third pillar of uncertainty that hasn't been resolved is still looming is around stimulus. I think that's the one that, especially since we're so retail driven, I think that's one that could impact the return after the holiday hangover. But I'm unsure what that looks like.
Fair. Well,
go ahead.
Oh, no, sorry, go ahead.
What we've been seeing for FMIC, which tends to look at more of the contracts, we've actually seen that some of the contract rates are starting to ease a little bit. Spot's still high, but it's not rising at the same rate. It's starting to peak out. And what we've seen, and so the bids coming back are kind of showing what will be put into contract coming in the new year. We're starting to see things ease up a little bit. They're still high compared to previous years, as everyone said, but the rate of growth is going down now. So we foresee that 2021, it'll start easing out a little bit. That's what we're seeing anyway with the FMIC contract longer term based data. The big discrepancy we're seeing is between asset and non-asset brokers. And that's still a big gulf there as far as what the rate increases are looking like. But in general, the market's starting to show signs of cooling a little bit from our side for longer term.
Right. Running out of gas, so to speak.
Yeah.
All right. So if you guys have any questions, just kind of call for questions again. We're going to start answering those now. Drop them in the comment or chat below. The first one is softball for Chris, and try not to be partisan here. But Kieran asks, which is the best course for supply chain analytics?
Mine. Yeah, so it's MITx, it's SC0X. There's a lot of good ones out there in any kind of analytics courses, but you can always go to MITx or edX, and you go to just Google supply chain analytics, it'll pop up. 300,000 people can't be wrong, right? They all, we'll see.
What's the Yelp review on that?
Very high, very high.
Yes. So Stefan asks, given rapid increase in online commerce this year, do we expect to see a huge uptick in reverse logistics after the holidays? That's an excellent question.
Yeah.
Who wants to tackle that one first?
I mean, it's kind of along the same lines as what I talked about with returns. I think there's going to be some significant increase. The numbers that we saw based on the Wall Street Journal report was a 200% increase in shipment size. So I think that's what's going to be the significant difference this year. Is given that returns move back along the same supply chain that they were shipped originally. I think that's going to add to the warehouse capacity problem that's already exists. So a lot of those warehouses, I talked to Zach Rogers at that runs the logistics managers yesterday, and he said that the big problem is warehouses. They can't find enough warehouses to meet demand, especially those customer-facing downstream warehouses, which means that returns are going to have the added challenge of trying to find space in those warehouses as they get returned. So a couple of things there. One is the size of the shipments and the volume, and then the congestion that will be caused in those warehouses as that volume moves back through the supply chain.
We have a question from Steven. Do we really believe that reefer rates will be at $267 a mile by the end of the year? That was actually one of the challenges that I had with the short-term forecast, is that the short-term forecast is a saturating forecast, and it was bumping up it was getting close to the ceiling over the last couple of weeks. And so it didn't want to kind of believe that rates were this high. And so in order to get it to fit what the recent history has been, I had to actually adjust the saturating ceiling upwards, which I think has some from beyond just like the math perspective of it. I know this is something that we've talked about a fair bit on the show, is the degree to which there's an upper bound on what the market will bear. And I think that's kind of an interesting question.
Yeah, I think people are staying home more, right? And I think grocery isn't as efficient of a consumption mechanism for refrigerated freight as commercial, right? It's like the same delivery density problem as package, where you have a much higher delivery density going to businesses than you do residential. That's why you have a residential surcharge. So I think if the Christmas season or the Hanukkah season, the holiday season is dominated by grocery as opposed to people going out, I think it will fan the flames of reefer rates, much like we saw in Thanksgiving. I mean, reefer rates far outperformed dry van for Thanksgiving, right, Dean? I mean, I'm looking back at the charts.
Yep, correct.
So I don't see any reason why that would back off. Now, I'm not going to bet against the number because I'm already wearing a ridiculous shirt and will continue to through the end of the year. Just to
that same Stiller sweater all the way through January 1st.
I do believe they're undefeated. I'm just kind of throwing that out there, except they have to play at 3:40 tomorrow. We don't want to step all over the Rockefeller Christmas tree lighting.
Let me ask about the reefer rates. Do you think the vaccine distribution will have any impact on reefer capacity? Is it an isolated set of the market, or what are your thoughts there? Do you think that's going going to impact and drive capacity even tighter?
I've never seen a reefer trailer that was hauling cabbage to load before pick up a load of vaccines and go deliver it. So, I mean, I've had experience where dirty trailers have backed up to a dock, even for like generic aspirin, and got turned away. So, personally, I don't want to speak for the group, but I don't think those trucks are fungible at all.
I'd agree, Ken. Sorry, Chris. I'd agree. I think it's more of an LTL expedited play. If you think about the whole mode of getting vaccines out is about speed and efficiency and safety and compliance. So that's going to require some high-end operations. It'll come with a premium, but you'll have to have really good logistics in place to get it out quickly. So if you're using planes, it's going to be a pretty smart team operation running LTL expediters to get that vaccine to population areas that are not normally served by planes and big truck networks in rural areas. So I think it'll be more LTL expedited.
There was an interesting article in the Wall Street Journal the other day about how a lot of the vaccination points will be grocery stores. And so it's kind of interesting how it's they're trying to figure out Operation Warp Speed, how do you get it down to where you need it. And so I don't think it'll be the first wave, because I think that's going to frontline and nursing homes and things like that. But the second wave of vaccines might be spread out more into more retail distribution. So it'll be interesting to see how it plays out. I really have no idea how it will go.
I think it's going to constrain bandwidth for FedEx and UPS. I mean, I think they're going to be...
Well, charter flights are now going. Delta is flying, and United is doing charter flights right now for the vaccine.
The first one just landed, I think, yesterday at O'Hare for the vaccines. But to your point, I think that final mile, to the extent that we call it that, will probably be on that passive packaging going to like a Giant Eagle or a Wegmans. That will most likely, I would suspect, go with FedEx or UPS versus a Hummer or a Humvee or whatever you want to call it. That'd be my expectation, but I'm over my skis at that point.
Yeah.
To use a snow analogy. So moving on, Mikkel, sorry if I mispronounced your name. Do you expect freight rates to slow down for January and February? Yes. Anyone else?
Yes.
Well, yeah. We're lagging still, right? Because the contract rates will lag spot. So if we see spot come going down, it'll take mid Q1 for the contract rates to go down, because they have that momentum going up still. But I see them cresting in Q1.
From a volume perspective, though, I mean, I'll wear a pompadour hat if things don't slow down after returns, right? I mean, January 15th ish, wherever that falls on the calendar, once returns have cleared the system, things will slow down until about the end of February, very early March. It's just.
I agree with you, but the only pushback that I'll give is, what if we do have to do like a very severe lockdown like we saw back during, maybe not even as we've seen in the US. Like if it gets to the point where we're having to like do an Italy scale lockdown where you literally cannot leave your house.
I mean, there'll be strong demand for pitchforks and torches, but other than that,
the retail channel, I mean, they'll shut down the restaurant channel and the industrial, but it won't shut down grocery, which has still been going gangbusters. So I don't know. We can still order things online. Do you think they'll lock down and no e-commerce deliveries? Because it'll just shift people to buy. We're still buying big things. So I don't know. I don't think it's going to have as big of an impact, but we'll see.
I don't think it's going to happen to even have an impact. I just don't. I think that toothpaste is out of the tube, and I don't think it's anything. I just don't. I don't know.
I don't necessarily disagree. I just you gotta consider all the counterfactuals and the angles.
Sure.
We have a question from Gary. Seasonality projection after Christmas will be low. Is that the projection or forecast? I mean, I guess it depends on what equipment type you're talking about. And I feel like that was slightly answered for Michael's question, maybe. But specifically, if we're talking about these forecasts that we were showing, we're expecting that there's going to be a little bit of a dip for reefer going into the Christmas season, and then it'll pick up just a hair afterwards. Van is pretty flat, and we're expecting a little bit of a pickup in flatbed post-Christmas is what the sort of normal seasonal trends are, as far as my forecasts go. I hope that answers your question.
I mean, that's probably, just to kind of build upon it, that is probably the single strongest seasonal pull of the year. is when things. I mean, if you go talk to someone who's worked or as a yard boss or worked in any LTL or asset-based truckload, that's when they're typically furloughing yard workers and dock workers, and they're just trying to hold on until the freight comes back in the early spring. So, I mean, that's going to be a very hard trend to buck. So we'll have to see what happens. Philip has a question.
Mm-hmm.
Are the data analyses made based on load postings with the rates visible? We talk a lot about high rates, but no one is considering the fact that the posted rates for drop trailer are higher than usual, therefore giving us a fake view of rate per mile. So, Philip, we've been getting these questions a lot, I think for years, even before we started doing the videos. So we're going to have a What's on the Rate View Rate video coming out in the new year. But just to answer the question, none of our rates are based on posted rates. They are all based on, for both FMIC and DAT. It's all DAT, but those two data sets, 100% actual freight transactions, moved freight transactions. So no posted rates, no offer rates, no factored rates, no modeled rates in the actual data, right? We do, cleaning and aggregation, and we fill in the holes in the map, right? But it's all based on actual freight transactions. So we have some data around power only. Not enough, I don't think. I'll look to Ned. Not enough to make any kind of lane level interpretations, but
that's unfortunate. I would just to kind of piggyback on that a little bit. For the exact reasons that you're saying is the reasons why we don't use posted rates is because people are only going to post a rate on the load board if it's a good rate. They're not going to, if you've got like a real crummy rate for something that you're willing to offer, you're not going to post it. And so it's going to systematically skew the rates higher. You absolutely identified why we don't do that.
Yeah, for sure. But again, more to come. We're already planning that one out. It may be a video series based on how much ground there is to cover, because I'd love to get to what's in a modeled rate as well when we talk about the contract side. So Jeff asks, I'm struggling to obtain total spot and contract load volumes on a lane level for thousands of lanes, finding discrepancies among data sources. So my suggestion would be, I think you have to be specific on what you're asking for. If you ask about total freight volumes, that lumps in dedicated and private, and that's going to be mostly impossible to get any kind of precise number on. When you look at for hire, I don't know of a source that's fully comprehensive. Do you, Chris?
No, take out LTL, throw away that 70 billion. It's a $600+ billion market. No one has a complete view of that. And if you throw in the dedicated with that, that makes it even harder. So it depends what you're really looking to do for this. I don't know why you would want on thousands of lane what the volumes are. Usually the rate is a good proxy for that. And so you don't need to have that detail. But you should reach out to us directly, and maybe we have some kind of data that we can help you with. You will always have slight differences depending on where you're looking in the market.
I think other than my brain gaffe earlier, if you look at CAS or ATA or DAT or FMIC, I haven't seen any major discrepancies. I like Jason. We did a panel with Dr. Jason Miller at Michigan State. He had a great line I've been using. It's the responsibility of the outlier to explain why they're the outlier. So you will find some data sources out there that are just way off in left field. Like everyone else is showing flat to up a little bit, and they're showing 50% up or down, or a lot of those are using like inflated tender data or something like that. So reach out to us directly at askiq@dat.com. I think we might be able to help out with some of that.
Yeah, or data analytic services. If you're an existing DAT customer and you have a relationship, there's some really crackerjack folks in that department, and they can
help for sure.
Answered.
Yeah, it depends what you're.
All right, I'm going to bring us to a close. What's that, Chris?
Resolve.
Yeah, for sure. So with that, I'm going to bring us to a close for this week. Just some housekeeping items. Again, check out Freightvine Podcast. Who was the most recent one, and who do you have coming up, Chris?
This coming Thursday, Shelly Simpson from JB Hunt will be on. Last one was 2 weeks ago with Frank McGuigan from Transplace. So Shelly will be with me on this coming Thursday. So join.
Shelly's awesome. I can't wait to listen to that one. Believe it or not, we don't get sneak peeks. We get it with everyone else. Let's not forget we're here next Wednesday. We're going to be taking some time off in December. I hope that's all right with everyone. We'll still be 24/7 at AskIQ@DAT.com, toiling away with your questions and comments. I can't think of anything else. Just check out Dean's market update at DAT.com. With that, we're going to sign off for the week, and we hope you have a great rest of your week and a great weekend, and we hope to see you next Wednesday. Bye, everyone.
Thank you.
Bye-bye.
Stay safe, everybody.